Companies laid off more than 1 million workers in the United States in 2025 alone. Over 1 million in a year when most of those same companies were reporting profits, posting earnings beats, announcing share buybacks. Most of those people who got let go were not bad employees. Most of them showed up on time, hit their targets, got decent performance reviews, maybe got a "you're doing great, keep it up" email from their manager 6 weeks before the calendar invite from HR appeared. And not the kind of calendar invite you schedule, the kind that lands in your inbox with a 30-minute slot called Quick Sync at 10 o'clock in the morning on a Tuesday. No agenda, just HR and your skip-level manager. And if you've been paying attention to the news for the last 3 years, you already know what that meeting is. Meanwhile, somewhere on LinkedIn, a 60-year-old executive is typing a post about how young people today have no loyalty, no commitment, no work ethic, no willingness to put in the time and earn their place. The post gets 40,000 likes. The comments are full of other executives nodding along, adding their own anecdotes about how Gen Z just doesn't get it. Some of those executives laid off people last quarter. Some of them will lay off more people next quarter. The algorithm doesn't flag that as a contradiction, neither do most of the commenters. Here's the thing, I'm 20 years old. I have never worked a 9 to 5 in my life. And from where I'm sitting, this situation is not actually confusing at all. It's just math and a little bit of incentive theory, and the fact that people on one side of the conversation have stopped asking whether the original deal ever actually honored in the first place. So, the question I want to answer today is not why is Gen Z disloyal? That's the wrong question. It's the question that sounds smart, but points away from the actual mechanism. The right question is, why would a rational person remain loyal to a system that has structurally different incentives than what it communicates? And once you answer that honestly, everything else makes complete sense. We're going to explain how the corporate loyalty system works and why it's getting weird. Not weird like surprising, weird like mechanically broken. We're going to look at the actual incentives, the real numbers, the psychological architecture of employment, and the quiet shift that's happening in real time as an entire generation figures out something that took previous generations decades to accept, if they ever accepted it at all. I'm not here to tell you to quit your job. I'm not here to sell you a dropshipping course. That's not this channel. The point of this video is to help you understand the machine you are operating inside of. Because once you understand it, you can make decisions with clear eyes instead of inherited assumptions. And clear-eyed decisions applied consistently over time are the actual mechanism behind financial accumulation. Not hustle, not passion, not loyalty, clear-eyed decisions. So, here's the one idea I want you to hold on to for this entire video. The central image, the thing that will reappear every time we go deeper. Think of the modern corporate job market as a conveyor belt in a factory. The belt keeps moving. It moves at its own pace based on its own logic. It doesn't speed up because you're particularly skilled. It doesn't slow down because you've been on it for a while and you feel like you deserve more stability. It doesn't remember that you stayed late in November 3 years ago and missed your friend's birthday to finish a deck that your VP presented to the board and got credit for. The belt is indifferent. The belt is mechanical. Items get placed on the belt. They move through the system. They get processed and eventually they get removed or replaced. The factory does not feel anything about this. The factory is not malicious. It's just a system running on incentives you need to understand. Now, here's the crucial historical piece. For about 50 years, roughly from the 1940s through the 1980s, the social contract around that belt was genuinely different. The implicit deal was coherent and more or less honored. You get on the belt, you give it 25 or 30 years of consistent effort and loyalty, and at the end we give you a pension, a defined benefit plan that pays you a reliable income in retirement. Security, predictability, you build your entire life around this arrangement, and it mostly works. The deal made sense for a specific economic and social context, manufacturing-driven economies, large corporations with long-time horizons, a regulatory environment that favored stable employment over financial engineering, union strength that enforced the employer side of the bargain. Most people who followed that deal in that era came out reasonably okay, but the deal changed, and the change was quiet, gradual, and deliberately so. Nobody called a town hall. Nobody sent a memo to the workforce saying, "Hey, we've updated the terms of your implicit employment contract, and we wanted to give you some notice." The change just happened in spreadsheets, in shareholder meetings, in the quiet elimination of pension programs, in the outsourcing of risk from the institution to the individual. And now we're in early 2026, and we're watching a generation of 20-somethings get called disloyal for responding logically to a set of facts that have been visible for about 20 years. Let me walk you through exactly what happened, because the timeline matters. In the 1970s and early 80s, if you landed a corporate job, the expectation on both sides was permanence. The belt was slow, predictable, and well maintained. Defined benefit pensions were standard in large companies. Layoffs happened in recessions, but were generally temporary and came with some social protection. The relationship between employer and employee had a long-term character to it, not perfectly equitable, but structurally designed to be durable. Then the 1980s brought financial deregulation, the rise of shareholder primacy as the dominant corporate ideology, and the beginning of the leveraged buyout era. Suddenly companies weren't just entities that made products and employed people. They were assets to be optimized. Quarterly earnings reports became the central scorecard, and headcount is one of the fastest ways to move the quarterly needle in the right direction if you know you won't personally feel the downstream consequences. By the 1990s, the defined benefit pension was already disappearing from the private sector at scale. It got replaced by the 401k, which is a fundamentally different instrument. A pension is a promise, a 401k is a contribution. The employer's obligation shifts from providing a retirement outcome to merely offering access to a savings vehicle. The risk of retirement adequacy moves from the institution to the individual. This is a massive transfer of financial exposure that mostly happened without anyone explicitly framing it that way. Then 2001, then 2008, both times large waves of layoffs hit people who had done nothing wrong. Career employees, loyal employees, people who'd been on the belt for 10, 15, 20 years. People who had made financial and life decisions based on the assumption that the deal was still the deal. Gone. With a severance package and a LinkedIn recommendation from a manager who felt genuinely bad about the situation and also couldn't do anything about it because the decision came from 3 levels above them in response to a spreadsheet that nobody in the room had worked to build directly. The people who grew up watching this happen with Gen Z, the ones who are now 20 to 27 years old. They watched their parents navigate 2008 at age 10, 12, 14. They watched what income disruption looks like when it's sudden and there's no cushion. They stored that information. It became part of how they calibrate right risk. Here's the data point that I think anchors this whole conversation. The median job tenure in America fell to 3.9 years in 2024. That's the lowest it's been since 2002. For workers specifically in the 25 to 34 age range, the median is 2.7 years. For Gen Z workers in the first 5 years of their career, the average tenure at any single employer is 1.1 years. Compare that to Gen Z who averaged 2.8 years at that same career stage. Compare it to baby boomers who averaged 2.9 years, more than double what Gen Z is currently averaging. Now, the standard interpretation of that number is that Gen Z can't commit, can't focus, won't put in the work. The more accurate interpretation, if you're paying attention to what else is happening in the data, is that Gen Z is responding correctly to an environment that is objectively more volatile, more transactional, and more likely to remove them from the belt without notice than the environment that Gen Z and baby boomers navigated at the same age. Our entry-level job postings declined by 29 percentage points since early 2024. The belt is offering fewer on-ramps than before. Tech companies alone laid off nearly 250,000 workers in 2025. Over 1 million job cuts were announced across industries in just 11 months of that year, up 54% from the same period the year before. That pace of layoffs puts 2025 in the company of 2001, 2002, and 2009 in terms of historical job loss. These are recession-level numbers happening in a period without a defined recession. And yet, when young employees respond to all of that by deciding to invest less identity and emotional capital into their employers, we call it a loyalty crisis. The belt keeps moving. The question is whether you know it's a belt. Now, let's run some actual numbers, because this is where the conversation stops being theoretical and starts being genuinely actionable. Say you take a job at 22, you're making $55,000 a year, entirely normal entry-level salary in most mid-size markets. You're a solid employee, you hit your deadlines. Your manager likes you, you get your annual performance review, and you get a raise. How much of a raise? The standard internal raise at most companies for employees who are not being promoted runs somewhere between 3 and 5% per year. Let's call it 4% to be generous. 4% of $55,000 is $2,200. Your new salary is $57,200. That's about $183 extra per month before taxes, maybe $125 after. That's a streaming service and 2 Chipotle burritos. Now, let's look at switching historically, and the data here is pretty consistent across multiple sources and time periods. Switching jobs has yielded a pay increase in the range of 10% to 20%. During the peak of the pandemic hiring market in 2021 and 2022, the average median year-over-year pay increase for job switchers was above 15%. Pre-pandemic, it was closer to 10%. Even in the current cooler market of 2025 and 2026, the job switching premium over staying put still exists, just smaller. But, let's use a conservative number. Let's say 10%. 10% of $55,000 is $5,500. One strategic move, properly timed and negotiated, and you're now at $60,500. Compared to the person who stayed and got 4%, that's a $4,300 annual income difference after just 1 year. And here's what matters about that number: it's permanent. You're now earning off a higher base. Every future raise, every future negotiation, every future role is priced off $60,500, not $57,200. Let's extend this out over 10 years. And I'm going to give the loyal path generous assumptions here. I'm assuming no layoffs, no recessions, no hiring freezes, no years of zero raises because the company had a rough quarter. I'm assuming the cleanest possible execution of the staying growth strategy. Person on the loyal path with consistent 4% annual raises starting from $55,000 ends up around $81,000 after 10 years. That assumes every single year they get their raise, on time, no interruptions. That is an optimistic scenario in the current environment. Person on the strategic movement path, switching companies every 2 to 3 years with conservative 10% increases each time, moves through the following trajectory: $55,000 at start, $60,500 after first move at year 2, $66,500 at year 4 after another move and some modest growth, $73,000 at year 6, $80,000 to $85,000 at year 8, $90,000 to $95,000 at year 10. Same time window, same effort level in terms of showing up and performing, completely different outcome. And I want to be clear, that is the conservative version of the job switching path. People who time this well, who develop in-demand skills, who move into growth sectors, can see much larger jumps. Some of the higher performing job switchers in high demand fields are landing 20 and 30% increases with each move, which produces income trajectories that are simply incomparable to the stay and grow path over a decade. But forget the optimized version, even the conservative version produces a cumulative income gap over 10 years that can run anywhere from $150,000 to $250,000 in total earnings difference. That is not a rounding error. That is a down payment on a house. That is the beginning of a real investment portfolio. That is the difference between having financial optionality and not having it. Now, you might be thinking, okay, but what about job security? What about building deep expertise in one place? What about the relationships, the institutional knowledge, the organic path to senior roles that comes from staying? These are real considerations, and I'm not dismissing them. But let me offer you a more precise version of that objection. The question is not, is stability worth something? The question is, how much stability are you actually getting for your loyalty, and how does that price compare to the alternative? Because here's the thing, the stability you think you're getting in exchange for your loyalty is not guaranteed. The conveyor belt has no contractual obligation to keep running for you. The company that you gave 6 years to can announce a restructuring tomorrow based on an AI implementation roadmap, a slowing market, or a new CFO who thinks your division is underperforming and your 6 years of loyalty is not a factor in that decision in any material way. Maybe it makes the manager feel bad. It probably does, but feeling bad doesn't stop the process. In 2025 alone, Microsoft laid off 6,000 workers weeks after reporting profits that beat expectations. Companies routinely cut employees while simultaneously posting positive earnings and authorizing stock buybacks. The belt keeps moving. The factory is optimizing for a different metric than your tenure. So, when you're calculating the value of stability, you need to use the actual probability of that stability, not the version you've been sold. And those are different numbers. Let me make this concrete. I want to give you 2 scenarios. Call them Jake and Daniel. Jake and Daniel both graduated 22 with identical degrees from the same type of school. They both get job offers at similar companies for $55,000 a year. They're both smart, hardworking, reasonably ambitious. The inputs are the same. The philosophy is different. Jake was raised on the old model. His father spent 31 years at a manufacturing company in the Midwest and retired with a pension. Not a big one, but a real one. Predictable monthly income. Jake's father's advice is earnest and comes from genuine experience. Stay, prove yourself, build a reputation, earn trust, and the system will reward you. Jake believes this because his father is not wrong in any dishonest way. His father is just applying a model that was calibrated for a different era. Jake takes the job. He shows up early. He stays late. He volunteers for projects outside his job description. He never asks for more than is offered. He genuinely cares about doing good work. His manager loves him. His team loves him. He gets average to slightly above average performance reviews. He gets raises that come in around 4% a year. Daniel's backstory is different. He watched his mother get laid off from a bank in 2008 after 12 years of uninterrupted service. She was 51. The severance was 3 months. She had to restart her career in her 50s in a terrible job market. Daniel was 10 when this happened. He didn't have language for it at the time, but the information went in and it stayed. Daniel also takes the job at 22, also hardworking, also reliable. But Daniel treats the job explicitly as a phase. He knows what skills he came to develop. He keeps a running private document tracking his outputs, his accomplishments, and his market value compared to what is being paid. He builds external relationships. He keeps his LinkedIn current. He doesn't do these things because he's disloyal. He does them because he understands that the bell can stop for him at any time. He feels good about his progress. His manager has told him he's on track for a promotion. At 26, Daniel's second employer promotes him to a team lead role, and his salary hits $72,000. He's building a specific track record of output he can quantify. At 27, he gets an external offer for $81,000. He takes it. Jake at 27 is earning $63,000. He was passed over for the promotion he was told was coming because the company decided to bring in an external hire for the senior role. His manager feels terrible about this and tells him he's almost ready. Jake stays. He trusts the process. At 30, Daniel is earning $94,000 at his third company. He manages a small team. He has a reputation in his field that exists independently of any employer. He's been saving and investing since his first raise at 24 because his income trajectory gave him enough margin to build the habit without feeling financially stressed. He's got about $85,000 in a brokerage account and retirement accounts combined. Not life-changing, but real. Jake at 30 is earning $68,000. He is genuinely one of the most knowledgeable and reliable people at his company. His institutional knowledge is deep and real. His relationships are strong. He feels mostly good about his work. At 31, Jake's company announces a restructuring. His department is being streamlined. His role is eliminated. He receives 60 days of severance, a written recommendation from his manager who is genuinely heartbroken about this and the news that his last day is in 2 months. Jake is now 31, earning $68,000, starting over in a job market that looks at his resume and asks why he only has one employer for 9 years. He has no external network. He has no external reputation. He has never interviewed before as an adult. He does not know what his market value is. He was told the belt would keep moving for him and he believed it, and now he is facing a process for which nothing prepared him. Here's the important note. Nobody in this story is a villain. Jake's father was honest. Jake's company probably did value him. His manager probably did advocate for him at some level. The restructuring was almost certainly driven by real forces well above anyone in Jake's direct chain of command. Forces that had nothing to do with the quality of Jake's work. The belt is not malicious. It is mechanical. But the cost of misunderstanding is not that you get betrayed, it's that you get surprised. And being surprised at 31 with no financial cushion, no external network, and no muscle memory for self-advocacy in the job market is a devastating place to start from. Not impossible, but expensive in time, money, and psychological cost that could have been avoided with a different model. Imagine an HR team writing a job posting that says, "We're looking for a passionate, driven team player who treats this role like ownership, work-life integration culture. We move fast and break things. Must be comfortable with ambiguity, competitive salary, and the chance to grow with us." Same company 4 months later, internal Slack message from the Chief of Staff at 6:30 in the due to strategic realignment, we will be eliminating 17 roles across 3 departments. Impacted team members will receive calendar invites from HR today. Treat this role like ownership apparently stops applying the moment the ownership actually benefits you. Now, let me go a level deeper because we've talked about the math of staying versus moving, the mechanics of the belt, and the psychology of why people get stuck. But there's something underneath all of that, which is the actual determinant of long-term financial outcomes. And it's the question that most discussions of Gen Z and what I completely fail to engage with. The question is, are you building leverage, or are you just building a salary? A salary is income that requires your continued time and labor to produce. You stop working, the income stops. It is structurally a system where your earning is directly capped by your available hours and the market rate for those hours. There is a ceiling built in, and crucially, the ceiling is set by someone else. Your employer controls the salary band for your role. Your employer controls whether your role even exists this next quarter. You are operating inside a structure with limits you did not build and cannot unilaterally change. Leverage is different. Leverage is any situation where your output is partially or fully decoupled from your time. Equity in a company is leverage. Invested assets that compound are leverage. A skill set that makes you 10 times more productive per hour than your peers is leverage. A platform, an audience, a network, an automated income stream, these are all forms of leverage. They work in some meaningful fraction even when you're asleep. And crucially, you control them. They are not contingent on someone else's quarterly earnings. Here's why this matters in the context of everything we've been talking about. The job switching strategy, even when executed optimally, even if you negotiate every move perfectly, time every transition correctly, land double-digit percentage increases with each jump, you are still playing the salary game. And the salary game, no matter how well you play it, has a structural ceiling. At some point, you are expensive enough that you become the person who gets cut to improve a margin. At some point, the market rate for your role plateaus. At some point, your physical energy and available hours stop expanding. The people who actually accumulate significant wealth do not win the salary game. They exit it. They use employment as a funded phase of capital and skill accumulation, and then they build something on the side of it or instead of it that operates under different rules. And this is exactly what a growing portion of Gen Z is doing, whether they frame it that way or not. Roughly half of Gen Z professionals are engaged in freelance work in some capacity. Among those with full-time employment, 31% say they would prefer to combine that full-time job with a side income source. This is not passion economy romanticism. This is the systematic application of a specific insight. A financial life built on a single income source from a single employer is a fragile financial life, and fragile financial lives produce bad decisions under pressure. The deeper game is not about which company you work for or how often you move. The deeper game is about building alongside whatever employment you're currently using a second machine that you own, one that generates output independent of your employer's decisions. One that doesn't stop when the calendar invite from HR arrives. And here's what I want you to understand about the psychology of this. The reason this matters so much right now, in early 2026, is that the cost of not doing it is higher than it's ever been. The volatility in the job market is not a temporary condition that will normalize. AI implementation is actively reducing entry-level job availability at a measurable pace. Over 250,000 tech workers were laid off in 2025 alone. The entry-level postings for roles requiring 0 to 2 years of experience have declined almost 30% since early 2024. Junior tech roles dropped 35%. Finance entry-level roles dropped 24%. The belt is moving faster and has fewer seats. The only rational response to that reality is to reduce your dependence on the belt as aggressively as your circumstances allow. Here's the thing about what's actually happening right now. 70% of Gen Z workers are actively developing skills every single week. They are using AI tools at higher rates than any other generation in the workforce. They are building side income streams, building platforms, building portfolios, building the conditions for eventual leverage while they're still inside employment. This is not laziness. This is not disloyalty. This is an entire generation running a sophisticated parallel strategy that older commentators are reading as a lack of commitment because the only metric they're using is tenure at a single employer. The belt keeps moving and a growing number of the people on it have started building their own machines. You know those companies that post a job listing requiring 5 years of experience for a role that has existed for 18 months with a salary range that hasn't been updated since 2019. And then they interview 12 people, extend an offer, and negotiate you down from the number they posted in the listing in the first place. And then if you accept, you get a welcome package that includes a weir like a family speech, a buddy assigned to help you onboard, and a laptop that takes 8 minutes to boot up. 3 weeks in, your buddy pulls you aside and whispers, "Don't send anything important in Slack." They read it. You nod slowly. You now understand everything. Welcome to the belt. Okay, let me give you the core reversal that this entire video has been building toward, because everything I've talked about has been establishing context for this one precise inversion of framing. You think the problem is that Gen Z is disloyal, transactional, uncommitted to their employers. That is the dominant framing in business media, in HR conferences, in LinkedIn posts by executives who genuinely can't understand why the model they operated in doesn't produce the same results today, but that's the wrong diagnosis. The actual problem is that Gen Z is the first generation at scale to refuse to operate under a contract that was quietly terminated several decades ago. And that refusal looks like disloyalty from inside the old framework and looks like accurate information processing from outside it. The original deal was explicit and coherent. Give us your best years, your full commitment, your prime productive energy, and in exchange we give you security, upward mobility, a pension, a community, a stable identity. That deal, when it existed and was honored, was a reasonable trade. It explained why loyalty made sense. There was a genuine structural incentive to be loyal. That deal got terminated not by Gen Z, by a combination of shareholder primacy philosophy, financial engineering, globalization, and the systematic offloading of institutional risk onto individual workers. Pensions disappeared. Job security became a marketing talking point rather than a functional reality. In 2025 alone, more than 1 million job cuts were announced in the United States. That's comparable to what happened in 2009 in the depths of the worst financial crisis in 80 years, except now it's happening without a comparable crisis trigger. It's happening as standard operating procedure. Rolling layoffs drip by drip, constant restructuring, perpetual realignment. Glassdoor's own data showed that employee mentions of layoffs and job insecurity in company reviews were higher in late 2025 than they were in March of 2020 when the pandemic first shut down the global economy. Workers felt less secure during a period of nominal economic function than during an actual global shutdown. Think about what that says about the underlying state of trust. Companies kept the give us your best years part of the old deal. They quietly retired the "we'll take care of you" part. And for a while this asymmetry was obscured by cultural scripts that hadn't yet been updated. You still heard the same language: "We're a family here. We invest in our people. Your growth is our priority." The messaging stayed warm. The structural reality became cold. And for a while, a lot of people didn't notice because they were inside the machine, and the machine runs on a kind of optimism that's hard to question from the inside. Gen Z grew up watching the scripts play out against a factually different backdrop. They heard the language, and they saw the layoffs. They heard "your growth is our priority," and they watched the promotion go to the external hire. They heard "we're a family," and they watched their parents walk out of the building with boxes after 20 years of service. They stored all of it. They made a logical inference from the evidence, and the inference was correct. The inference is not all corporations are evil. It's not nihilism. It's not work is meaningless. The inference is the terms of this arrangement appear to be different from what is being communicated, and I should incorporate that into my decision making. That is rational behavior. It is the only rational behavior. And the people who want Gen Z to be more loyal are, without realizing, asking them to behave irrationally in the interest of the entity asking. Now, let me give you a structured framework. I call these the 4 traps of the conveyor belt. These are the 4 specific ways that intelligent, hard-working people end up losing in a system they theoretically had the information to navigate. Understanding them doesn't guarantee you avoid them, but not knowing about them almost guarantees you'll fall into at least one. Trap number 1 is the identity fusion trap. This is when you allow your job title, your employer's brand, and your professional role to become your primary or dominant identity. The problem here is not just emotional, although it creates enormous emotional problems. The deeper problem is that identity fusion makes you systematically incapable of evaluating your situation accurately. When your sense of self is fused with your employer, every negative signal about the company feels like a personal threat. The impulse to look for other jobs feels like betrayal of yourself. The natural human instinct toward cognitive consistency means you will unconsciously filter incoming information to protect the identity. You'll explain away warning signs. You'll rationalize below-market compensation as investment in something meaningful. You'll stay in situations that a detached analysis would flag as net negative because leaving feels like dismantling a part of yourself. This is not weakness. It is a very predictable cognitive pattern, but it is one that the structure of employment quietly encourages because an employee whose identity is fused with the company is an employee who is extremely cheap to retain. Trap number 2 is the optimization without exit trap. This one catches the people who are already sophisticated enough to be skeptical of trap 1. You've read enough. You've thought enough. You know the game. You job hop strategically. You negotiate well. You build transferable skills. You develop your network. You are running the salary game at a genuinely high level. The problem is that you're optimizing entirely within the employed framework without building any position outside of it. You are getting very good at a game that has a structural. At some point the salary optimization path runs out of upside. At some point you are expensive enough to become a target in a restructuring. At some point the market rate for your role, regardless of how skillfully you've navigated to get there, plateaus. The optimization skills are real and they matter, but they need to be in service of an exit trajectory, not just more efficient belt riding. This trap is subtle because it feels like the right answer for so long, and it is the right answer up to a point. The question is whether you have clarity about what comes after the optimization phase. Trap number 3 is the premature exit trap. This one is important to name because the opposite error from excessive loyalty is equally destructive. You absorb enough escape the 9-to-5 messaging. You read enough about financial independence. You feel enough urgency about not being on the belt forever, and you convince yourself that leaving employment before you've actually built real capital, real skills, and real leverage as a liberation move. It is not. It is just moving to a different, more precarious situation with less institutional support. Starting a business with $8,000 in savings, no domain expertise, and no network is not freedom. It's a different kind of belt, and one where the consequences of being removed from it are more severe because there's no HR department, no Cobra health insurance option, no colleague network to tap for reference calls. Employment used correctly is a genuinely valuable resource. It provides stable income that funds investment. It provides access to experienced colleagues whose knowledge would cost you years and real money to acquire independently. It provides exposure to real business operations at scale that teaches you things you cannot learn from books or content. It provides structure that many people underestimate until they no longer have it. The goal is not to leave employment quickly. The goal is to extract maximum value from employment while building something that reduces your dependence on it. Leaving too early burns the resource before you've taken full advantage of it. Don't romanticize departure for its own sake. Trap number 4 is the waiting trap. This is the quiet killer, the one that is the most common and the most costly because it is the most invisible. You know the system is suboptimal. You've done the analysis. You understand that the belt is moving. You have a general sense that you should be building something independent. You might have even started thinking concretely about what that would look like. And then you say to yourself, I'll start seriously investing when my student loans are a little more manageable. I'll launch that side project when I have a slower month at work. I'll start really building my network when I'm in a more stable place. I'll take the risk when things are less uncertain. Things are never less uncertain. That is the defining feature of material existence in the 21st century economic environment. If you're waiting for certainty before you act, you are functionally committed to inaction. The waiting trap is not laziness. It is a very understandable cognitive defense mechanism against the anxiety of action in an uncertain environment, but it has a catastrophic compounding cost that most people don't calculate until it's already been extracted from them. The difference between starting to invest at 22 and starting to invest at 32, all else being equal, is roughly 10 years of compounding. At a 7% average annual return, $1,000 invested at 22 becomes approximately $15,000 by age 65. The same $1,000 invested at 32 becomes approximately $7,500. You lose half the outcome not because you made worse investment decisions, but because you started late. The math is brutal and it doesn't negotiate. Time is the one input in the compounding equation that once spent, you cannot recover. The 4 traps are not exotic. They are not rare. They are the default paths that the structure of the system leads you toward. The belt moves, the traps are on the sides, and the only protection against them is understanding them before you're already inside one. So, let's come back to the beginning. We started with a simple question. Why does Gen Z refuse to give their best years to a company that would replace them tomorrow? And by now, the answer should feel almost obvious. They watched the original deal get cancelled in real time. They did the math that reveals how the salary optimization dynamics actually work. They processed the pattern of corporate layoffs across 2 economic crises and a pandemic and arrived at a rational conclusion about the actual probability of institutional stability. And a growing, visible, measurable portion of them are doing something that previous generations didn't do at the same scale or the same speed. They are building parallel structures while they're still employed. They are treating employment as a phase rather than an identity. They are using the income and skills from one machine to fund the construction of a second machine that they own. This is not cynicism. It is adaptation, and it is the correct adaptation given the available information. Only 11% of Gen Z workers plan to stay in their current job long term. Only 18% of workers under 30 express a strong desire to remain with their employer for the foreseeable future. Those numbers look alarming if you think the old deal still exists. They look completely rational if you understand what actually changed and when. The companies that are most vocal about Gen Z's alleged loyalty crisis are in many cases the same entities that have normalized mass layoffs, eliminated defined benefit retirement plans, replaced full-time roles with contract positions to reduce benefits obligations, and built executive compensation structures that reward stock performance over workforce investment. If the relationship is purely transactional on the institutional side, it will become transactional on the individual side. That's not a cultural failure, that's just incentive symmetry operating as it always does. Here are 3 things that are actually useful, not generic, not motivational, structural. First, Treat your employment like a funded education, not a relationship. This means being explicit at the start of every role about what you are there to extract, which specific skills you need to develop, which relationships you need to build, which outputs you need to create that you can point to in future negotiations. Set a mental timeline, not "I'll leave when I'm bored" and not "I'll leave when they make me." Set a timeline based on when you will have extracted what you came to extract. 3 years is often a reasonable window for a meaningful learning cycle. When you've completed the cycle, move, not dramatically, not with resentment, just with the clarity of someone who understands the belt has a different function for you than the belt understands itself to have. Second, start building a second income stream before you believe you're ready. The threshold for readiness that you're waiting for does not exist. Start somewhere. Index funds are the most accessible and the most well-documented version of this for most people starting out. If you're making $60,000 a year and investing 10% of it starting at 22, you are in a meaningfully different financial position at 35 than the person who waited until they were fully ready. The specific form of the second stream matters less than its existence and its consistency. The psychological function of having any meaningful asset base outside your salary is that it changes how you negotiate, how you make career decisions, and how much fear-based decision-making governs your professional life. People with options behave differently than people without them. Assets create options. Options reduce fear. Reduced fear produces better decisions. The chain is mechanical. Third, learn to price your loyalty correctly. Loyalty is not a virtue when it's given unconditionally to entities that operate purely on incentives. Loyalty is a negotiated resource. It has a value and it should be exchanged for something of equivalent value. If an employer provides genuine development, real advancement, equity, demonstrated long-term investment in your financial well-being, then calibrated loyalty to that employer is a completely rational and financially sound decision. It is a fair exchange and should be honored accordingly. But, if what you're receiving in exchange for your loyalty is a salary in the market range, a vague promise of eventual promotion, and a quarterly all-hands meeting where the CEO shows a slide about values, you should price your loyalty at exactly what that exchange is worth. And, based on the structural reality of what corporate employment has become for most workers, it is not worth unconditional commitment of your prime productive years and your psychological security. The belt keeps moving. Understanding the belt is not cynicism. It's not Gen Z being difficult. It's just seeing clearly if this kind of analysis is useful to you. Subscribe. I make videos about how systems actually work, not how you're told they work. That's the only kind of content I'm interested in making.